back, ICA. We've now gone over a couple of important topics. The most recent one, supply and demand. We've got an idea of the numbers foundation already. And what we're going into next is we're going to talk a little bit about business, right? Because when you do interact with the markets, you ultimately are investing in businesses. That's what this is all about. But at the core of it all, we do need to understand what is actually happening. So with that being said, there's this book that one of my good friends actually, gave me a little while back, and it's talking about dividends and investment in companies. Now, you have your own option. You can always, go ahead and read this book, get it yourself. But in there's a chapter number 4 where they talk about Johnny and the lemonade stand. And I thought it was a really great way to introduce this to you guys, simply because it's a pretty simple concept. We can all imagine opening up a lemonade stand as a small business and ultimately trying to make some money from that, okay? Now, again, in your mind, it could be your own resale store of shoes or, buying and selling electronics, doesn't matter. But here with Johnny's lemonade stand, the concept here is the fact that Johnny has decided he wants to start his own lemonade business, but he's broke. He's got $0 in his piggy bank. He doesn't have investment money, but he does understand that for him to get a year's worth of supply of, lemons, sugar, cups, etc., for his business, he needs about $200 right here. So that's just the round number we're going to use for this example. Now he goes to, let's just say this is his parents' friends. 2 of his parents' friends decide, you know what? We're willing to give you $200 each, okay? That way, you've got $400, you've got 2 years of expenses ready, but we're gonna each take a small part of the company in terms of the contracts or the equity, give us each 25% of the business. Johnny himself is gonna have 50% of it. And so over time, it's very likely over the first year, the costs of the $200, he's still got money left for next year, but he might not be profitable right at the beginning. The 2 investors here are looking for the future growth, expecting that he's going to build a clientele and a customer base and ultimately make money from that. The final equation is just going to be how much money, how much revenue he brings in, subtracting his costs. All right, that's the basic formula. Obviously, accounting can get much more complicated, but at the base of it, what money you bring in, subtracting how much money you spent, that's going to be your profit margin. And we obviously want to have a positive, meaning bringing in more revenue than we have in our costs. For example, if our costs happen to be extremely high, then obviously it's not necessarily going to be a great idea. Let's say in his second year, right, he brings in $1,000. That means with the $200 cost, he's going to hold on to $800, right? He's going to make some money now. Now, think of it this way. If in his second year, he makes $800, he has a choice with these investors, depending on their equity contract. His earnings can be put back into the business. He can invest in more things, more supplies, expand, open up a second lemonade stand, hire somebody possibly, or he can pay out what's called a dividend or an earnings dividend to his 2 investors who are part of the company. Now, realize this, as the company continues to bring in more money, let's say it continues to grow, the original equity of the $200 that they put into starts to grow with it. Now that really brings in the next question is what would you say this company is going to be worth, right? Let's, for example, this first year when they only brought in $200, what would you be willing to, pay for this kind of company? And that's where we take the consideration of their earnings, what if they're reinvesting, what their cash flow looks like. And it brings us into our first introduction of what's called a price to earnings ratio, the PE ratio. If on the low end, he was bringing in only $200 a year, if you spent $1,000 to buy this lemonade stand from him, it would take you 5 years to get that back, right? If he's making that much amount, that would be a 5x price. The price is 1,000. The earnings is 200. So 1,000 divided by 200 is 5. That's your 5 times PE ratio. Obviously, if I put zeros after it, it just increases the rate or the scale of what we're looking at. But if you brought in $2,000 a year with that company, a 5x PE ratio is about $10,000. Okay. Now, what is considered a fair market value, right? Just because, like, if you've ever gone to go get seafood, there's a market price, what the market's willing to pay. What is the market willing to pay when it comes down to a company is going to be calculated by that earnings. What the company brings in, there's usually going to be mathematical values and averages, price to earnings ratios that we want to consider. Long-term averages for price to earnings, okay, stands around 15. Okay, so what that means here is if you're bringing $2,000 in a year times 15, $30,000 might be what somebody would pay for it. It would take them 15 years to get that money back if they continue to make money at that rate. So 15 is already, 10 to 15 is a solid range. Sometimes in moments of euphoria, etc., you'll notice that prices can jump pretty high, but they always come back down, back toward those means, those averages, okay? Especially in 2020, with what ended up happening, we actually have another spike in here. And ultimately, a lot of price to earnings ratios have been quite inflated. I want to point that out. Now, why would somebody maybe pay more? Why would somebody maybe pay less? Well, you want to pay more if you believe that the earnings is going to grow over time. So yeah, maybe today it's $200 that he's making or $2,000 he's making per year. But what if in the future it turns into $20,000, right? And that earnings, if you paid 30K for it, then eventually it'd take much less time for you to make that back. So the perception of future growth is always going to play into what people are willing to pay. But at the end of the day, cash flow is extremely important. They need to bring in that revenue, bring in extra dollars, and more dollars than the dollars that they spend, okay? With that being said, what I've done here is you can actually go into TradingView on the right side. I'll pull up the charts in a moment so you can find this, but I just wanted to put these guys side by side. What you have here is Apple, right? And what their earnings, you can see here, basic earnings for that year, for each year that gets paid out is going to be about, let's just call that $6, $5.92, okay? And so if you take this 100, write this down, 148 and 50, and you divide it by this 5.92, right? The price of it today divided by the earnings that it gets per year, that's going to give you this 25.59 PE ratio, okay? Now let's go real quick, look back. 25.59 compared to everything else right here, that's kind of on the high range when you think about it. 25 PE ratio and 25 PE ratio, you can understand are going to be considered some of the higher values here. So, in terms of the valuation of the company, you can see with Apple, there's perceived growth with it. It's going to continue getting bigger, etc. But 25 is still kind of high, you might understand. In terms of times of euphoria, it definitely can go higher, but in times of recession, times of contraction with our economic cycle, this very likely can start to shrink. So, keep that in mind. Here, what we have is Google. Google's sitting at about a 20.65. And you can see they brought in about $5. $5 times that 20 gets you very close to this $90, right? $90 to $100. Because they're not quite at $5. They're more like $4.50. Then here, I want to point out Tesla. I want to point out how Tesla, I've been teaching this class for a bit now. Tesla at one point had a PE ratio that was actually well over 100, like 110, I want to remember and say. That's pretty ridiculous. That's to say that if they're going to give you $4 for earnings every single year, times that a 40, almost 50, gets you close to this, current price. Relative to averages, to means, and to that, you can imagine that's high. That's high off of this, right? That's above these values, right? So with Tesla, there is going to be heavy downward pressure simply because the valuations are linked to hopes and dreams at this point. You can imagine the company still needs to grow. There is perceived growth. They are getting bigger, but for you to pay 50 years worth of earnings, it'll take 50 years for you to get this back, right? So in terms of a historical valuation, historical PE ratio, the price to this earnings makes this severely overvalued, if that makes sense. All right. Now let's go into a couple of our charts real quick because I do have Tesla pulled up here. What I want to do is actually, let's pull up this. NVIDIA recently has popped quite a little bit. And you can imagine analysts will say what they want to say on here. Come on. There we go. Okay. Price to earnings ratio for NVIDIA right now, if you guys see this right here, 134.58. So they only bring in $1.76 per year for their earnings. You know, they are a heavy growth stock, but at the end of the day, it's going to take you 134 years for this to get back to this to bring back your investment of $229, $230 here. Okay, so this is heavily overvalued, which does bring in additional downward pressure upon it. Okay, because just like we have talked to you guys about those averages, the mean, eventually these companies will eventually still be perceived normally at the end of the day. Yes, NVIDIA, they've got great growth. They are producing a lot of chips for a lot of different people, but does it still make sense that you're willing to pay 135 years worth of earnings and paying that in this market? That value is extremely overpriced and will sooner or later relax back down to earth. That's just how the numbers are going to play out. Okay, so that being said, sorry, my dog. With that being said, today's quick little, shorter session is based upon the understanding of this lemonade stand business and how price and earnings are related to each other. There's always a perception of how much a company is worth due to how much money it brings in. If a company isn't profitable, it's not going to last. We will talk a little bit soon about the marketplace and how, ultimately, instead of Johnny seeking out these, friends of his parents or, acquaintances or people that are investors in his area and going through a private type of funding source, what he can do is he can go to the marketplace, which you can imagine is kind of like a mall for stocks, and put himself and give himself a place where people can acquire and buy in equity through their system. So this is just the very beginning of it. We're trying to simplify this as much as possible for you guys. I do understand sometimes this might not make sense in the first time that I teach it, first time that I explain it. You can always rewatch these videos, but if they do still, have trouble clicking with you, please don't hesitate. Let me know. I'm more than happy to help you guys and help you out with understanding these concepts as best as possible. With that also being said, very last thing is just that how that his little lemonade stand, you want to understand, is going to be one tiny little marble inside a giant marble jar of the stock market. Okay, and so he is still considered, but he's going to be, tiny fish. He's like a guppy in terms of a guppy in the entire ocean of stocks and of companies. So the size of the company still will matter. We'll talk about those things as well. The stability of prices, new companies, old companies, etc. But as of so far, you've been through a couple classes and that foundation for your understanding of this is starting to grow. Please, again, let me know if you have questions, and I'm more than happy to answer those for you. With that being said, it's Eric signing off. I'll see you in the next video.